Welcome back to Chart This. I'm Jeremy Safran. Okay, gold is currently up over 50% year to date, but when you zoom out, the chart looks historic. Look at that spot chart. The last 3 weeks have been a brutal reminder, though. The volatility is the price of admission for these kinds of returns. Now, we saw that parabolic move to nearly $4,400, followed by a sharp, necessary consolidation. We saw another little spike, followed by another little sell-off. And on October 28th, our guest sat in the chair, predicted this exact pause. He identified a sequential 9 exhaustion signal that told us that the market had to breathe before it could move higher. Now, the question today is about structure. The fundamentals that drove this rally, debt, geopolitical instability, and central bank buying, those have not evaporated. Now we need to determine if the technical cool down has done its job. It has prepared the market for the next leg up. Joining me to analyze the health of this bull run and the outline to the path to 2026 is our very own contributor and editor, of course, of the goldforecast.com, Gary Wagner. Gary, welcome back.
Great to be here. It's been a while, and interesting action in gold. It's taught us a really important lesson. Even in a raging bull market, gold will not go straight up. It will correct. And that's to be expected. You're not going to get a scenario in which gold goes in one direction forever. I think Ben Bernanke, a former Fed chairman, put it best. He was talking about interest rates, but it pertains to gold. Trees don't grow to the sky. They never have. They never will.
Yeah, well said. And I mean, if you look at the technicals too, I mean, you successfully called that top at 43.81 using that sequential 9 pattern. It was a really precise call when everyone else seems to be chasing the momentum. Now, you said in the last time we had you on the show that it would come back down. We'd see a little bit of a sell-off to around $3,800. Now, it did come close. It was about $3,900. It bounced. Now, take us into the classroom for a moment. For the viewers who aren't technical experts, what specifically did you see in that candle pattern that screamed sell? I mean, and critically, are you seeing the inverse pattern forming at 4,000 right now as a signal to buy?
Yeah, the screen that you're looking at, I basically got a very simple study. Let me just center it. And all I'm doing is what's called a basic Fibonacci retracement. That's this red line. And it starts really from this part of the rally, September 19th. Gold's at 36.96. From there, it pops to the all-time record high above 4,400. I can't believe I'm saying it, but I'm looking at the chart, so it must be true. And then it came down. But if you look at the amount that it came down just below a 61.8% fib retracement. That comes in at 39.62. The lows that came in, there's a tail that came in around 39, but these real bodies came in around 39.40. That is an acceptable correction when we consider gold ran from 36.80 up to 4,400. You're going to get corrections. You're going to get profit taking in a bull market. A 61.8% retracement is absolutely acceptable, excuse me. And if I can put one more number up there, if I can see it, a 78% is also extremely deep, but acceptable. It's not up there, but the 78 would have taken us probably to these lows right here. So you've got gold still in a fully bullish demeanor. And when I say that, that doesn't mean it's going to go parabolic straight up forever. What it means is that as it goes up, it will correct. And when it corrects, it will correct an acceptable amount. A correction more than 78%, we start to question whether or not we are shifting or pivoting from bullish to bearish. Right. A move just below 68% is really an acceptable correction. Now, here's the thing that does concern me, and that is it came down to a 61.8% retracement, a little bit below that. Then it moved back up on Thursday, November the 13th. We hit this high, and then we've seen it come down for the last 3 days. That is not what you want to see. That could be indicating, to me, it says we're getting a consolidating trend. We're getting a range-bound market. I am not ready to say we've gone from bullish to bearish because the chart doesn't suggest that. The data doesn't point to that. However, a hard break below call it 39.60, maybe even to like 38.90, then it brings into question whether or not this bull market is over. But if we kind of compress this even more and take a look at what preceded this move, and we're going back to the beginning of 2025. Can you believe at the end of last year, beginning of this year, gold was sitting at $2,600 an ounce? I mean, that's a huge, huge move, considering it moved from 26 to 44, almost a doubling in price. So when you get this kind of a move with really no huge correction, if you look back at the end of December, it's at 26. It's where my cursor is. It comes up, you get a small correction. You got this one correction here in April 2025. It's at 31.92. Let's round it up to 32. And then it comes down to 29. Really acceptable correction. Pops up, you get this double top, and then it comes down to about 3,100. Again, a very acceptable correction. From there, it kind of slowly meanders, no real corrections, and then where the box is when I'm labeling it as the beginning of this parabolic move from 3670 up to 4,400 plus. So the fact that it went up to 4,400 plus and came down just below the 61.8% retracement, in pure technical terms, to a chartist, and I call myself a hybrid trader in that I acknowledge fundamentals move the market, but technicals and numbers are a way for us to kind of gauge where it is within a trend. This kind of move from 4,400 down to about 3,900 and then popping back up is an indication of a healthy correction. Now, what we need to see, and this is the one thing that I haven't seen, and that is it does pop back up, but now we have a lower high. So 4,200 here in the middle of November, 4,400 at the absolute top. That doesn't mean that the bull market is over, but it throws kind of a wrench in that idea, because the fact that it came down and then made a lower high. Now, it's only been 3 days that we've seen it come back down, so we could see it turn back around. We know that's going to be fundamentally based. Everyone is expecting a rate cut by the Fed, but I believe that that has pretty much been factored into the market. Mm-hmm. The question is, we do not want to see gold break back below, call it 3,900. Which is below the 61.8. We certainly would not want to see it go to 3,800. That could bring into question whether or not we're witnessing the end of it. Right now, we've got a range-bound market. We've got highs at 44. We've got lows at 39. It's a wide spread. And the one thing that I am concerned about from a bullish standpoint, doesn't mean it won't turn around, is the fact that this high here, compared to this recent high, middle of November, is a lower high. Right. You typically don't want to see it, but trading's not over yet. The month isn't over and the year isn't over. We could get a Thanksgiving or Christmas rally. We've seen that happen before. The bottom line is gold is going to move not based on what we see in a chart. A chart simply reflects what has gone in the past and helps us make sense of it. But most importantly, it's the fundamental news that comes out. Yeah. And a rate cut, of course, is a positive bullish factor for gold. Gold tends to work best in an environment when fixed yields are lower, because higher fixed yields draws investment money into that asset class. So it's only one rate cut that we're looking at, but we start seeing rates getting cut 2, 3, 4 times. That's a different story, but that's not what they're saying. And then the other thing I do want to mention about rate cuts is the Fed's going to be I'm surprised they're cutting rates with inflation near 3%. That does not make sense. Yeah. So it's odd.
Yeah, no, for sure. I mean, the macro market has been pricing in that risk on the Fed put, as you said. I remember last time you were on the show, you labeled this pullback that we just covered kind of the primary wave 2. Does the price action this week suggest that we kind of establish that solid floor here at 4,000? I know you were talking, you said you don't want it to go back below 3,900, but does that structure kind of that deeper test of 3,800 level before the primary three wave hits again? Can that begin?
Excellent point. What I'm labeling is this long rally up here from about 36 to 3,900. I believe it was probably a wave three, but it's definitely an upside move. The correction is acceptable. What I'm troubled by now is that this current rally kind of fizzled at 4,200. We've had 3 solid down days. If in fact gold turns around, and we've seen that happen before, I'm trying to look at the chart. Typically, recently, we don't get too many red candles. That's where it opens and then closes lower. That's something like this red candle. Green candle simply means it opens and closes higher. You've gotten 3 red candles right here. That's actually a candlestick pattern called 3 crows. It can represent a bearish continuation, but here it did not. It then found support at this level, a logical level, right around the 61.8. It came up and now it's moving back down. We don't really want to see gold make a lower low than say for 39.40. That's these lows that came in through October. That would bring into question whether or not we've gone into either a bear market or more likely a range bound market.
Right.
Because when you see gold move as much as it's moved, as fast as it's moved, you're going to get corrections, A, and B, you're going to get points in which it consolidates. It forms a base. And so after it comes up, it comes down. And this area here from, call it the end of October through the first week of November, even though it's not a straight linear line, you do have a range in there. That's a range. That's a consolidating market. But it did find support here. It popped here. As I said, the only thing I bring into question is you would like to see gold come and challenge the all-time record highs and to make a higher high. The fact that it's come down for 3 days doesn't tell us yet that the bull market is over, but it tells us that it didn't have the ability to make a higher high, and that brings into question whether or not this bull market will continue. I am more likely to believe we'll see range-bound activity, especially through the holidays, unless there's strong fundamental news to push the market up or down in either direction. It's as likely that the volume, and you can see it's decreased just a little bit. See how strong the volume was during this uptrend. You can see the volumes come down, and we are going into a holiday season. Traders tend to, rightfully so, want to spend time with their families and not stare at charts and take a break from the activity. So we can get moves that are exaggerated because volume goes down. Whenever you get thin volume, it takes less to move a market in either direction. So the key is that gold needs to hold above 3,900. If it does not, that tells us one thing. Even if it comes down to, say, 39.60 and moves back up, that's still a very acceptable movement within a bull market, still intact, but consolidating. It is running out of energy.
That makes sense. That's what I was going to ask you, Gary, because I mean, it would imply that we're kind of stuck here for a few months, that famous December trading. If we're stuck in a box, I mean, it's the hardest environment for a trend trader. Paint the line for us, right? I mean, if this is a range, what's the ceiling where we should be taking profits, and where's the floor where we should be brave enough to buy?
Well, that to me is very easy to see. Yeah. Right now, there is a major floor between 39.60 and 39.30, and that's based on these lows here. Okay. Obviously, the main level is, call it 36.80, which is the beginning of this rally. If it breaks below that, we are in a bear market. If it simply trades lower to 39.60, 39.30, it still could pop back up. More likely, as we get close to the Thanksgiving holiday here, and Canada has it's another name, but you guys celebrate something at that same time. And then we're getting into the seasonal holiday of Christmas and New Year's. The volume's going to go down. The market will have less volume, meaning it will take less to move it. And so fundamental events will have a greater effect. Right now, all I'm seeing is a market consolidating with the possibility of lower prices. And I only say that because we've had 3 consecutive down days.
Yeah.
If you look at this entire area of the chart, even here, you had a huge down day, another down day, and I'm just referring to it as a red candle. Here, you did not get a lower low. Here, you did not get a lower low. And then here, you had 1, 2, 3, 4 down days. And then it bottomed. It found support here. And here, the majority of candles have been green. So it moved back up, but it did make a lower low. Because we, excuse me, are in record territory, I can compress this chart till the beginning of the chart. It's not going to show us another time at 4,200. So as a technician, I don't have the tools to say, last time it was at 4,200, it did this, because the only other time it was there was right here. And that was on the way up, and then it came down. So we don't have a lot of historical data, which is a great thing because it tells us we're in record territory, and that's exciting. The key is this. I would like to see gold hold 4,000. I believe the new floor on gold is probably going to be 3,900 as long as we are neutral or bullish. A break below 3,900 is something that we want to guard for, and obviously a break below 37 or 36 tells us that we'll probably have seen the pivot from bull to bear. Doesn't mean the bull won't come back, but we are in a bear market and have to acknowledge that. Right now, we are not at the lowest low it's been since it hit this all-time record high. But my God, when we look at the basic move we've seen in gold, it's huge.
What a year. You and I have been talking about this for, a couple of years. I mean, it's been a year, but still just a rally. I mean, up almost 56% year to date. I got to bring up silver just for a quick second, because last time we had you on the show, you brought up a family dynamic. I know your son Joey's been pounding the table on $60 silver target. We saw that massive surge to about 54.42 on the spot side, followed by a sharp rejection. When you look at the rejection at 54 on the monthly chart, is the old guard technical model telling the young gun to take profits, or are you kind of backing his call for a breakout early next year here?
It's not old gun, new gun, but what it does tell me is the facts are the facts.
Yeah.
Resistance at just below 53, just below 5,400 was absolute. You've got this double top. So that's the mark you've got to beat. That's also a new all-time record high. It's the first time that silver's actually done that. We've seen gold, I don't know how many times it's hit new record highs this year. I think it's around 27 or more. I could easily be way off of the mark. But what I do draw your attention to are these 2 moving averages. The 50-day is in green. That is what most market technicians view and use as a line in the sand as to whether or not stock or commodity, in this case silver, is in a bullish or bearish trend. And when we look at it, there's an instance in August, but for the most part, really since May, it has been above the 50-day moving average. The one in purple is a shorter term 21-day. They're both simple moving averages. They're not exponential. And so you can see that we've had lows that have come near here. This will be an important level to hold, 4,900. If it breaks that, the critical level to hold will be $47 per ounce. And it kind of matches roughly with this low here at 46. As long as it remains above these moving averages, it's simply a market that's moving up and correcting before moving back higher. The only thing that's really different when we think about the gold chart that we looked at and compare that to what we're seeing in silver is this is clear as day, a double top. And so a double top signifies a pretty strong indication, because for a market to come out up to a certain point, that's a new all-time record high, and come down, find support, and then move up isn't telling us that much. But when it comes up to that same point and once again begins to fall, and now it's the third day, so it's more than a single day, it doesn't mean it won't find support at 49, does not mean it will not find support at 47, but it brings into question whether or not we're looking at an absolute top. It is a all-time record high. Gold's all-time record high has not been challenged twice. It made it, and it's been below it ever since. Silver finally did something unique in its own price structure. It broke well above 50, which was the former level that we all looked at. It went higher than 53. We are looking at futures, so that's a little bit above spot. But the bottom line is there is a double top. We've seen 3 down days, but now we're at critical areas that are important to watch. 49.20 and 47. Those are price points that if it holds, we can easily make the observation that silver is still in a bullish demeanor. If it breaks below the 50-day, we can no longer say that with confidence because the chart, the numbers don't agree with that statement. That's all it is.
Yeah, well said. All right. Well, there's also that backwardation on the spot and the future side, which will continue. It's a different story for a different day, but we'll continue to follow what that means in terms of the tightness of the silver market too. Gary, we only got a few minutes left, but let's look forward. I mean, you talked about that possibility that primary wave 3 moves are typically the strongest and the longest. If this consolidation resolves to the upside, we're looking at targets well beyond maybe the old highs. Give us a roadmap for Q1 of 2026. I mean, is there any specific price targets that your model kind of projects once this correction concludes? I mean, are we talking 5,000?
I am searching Q1 for 4,500 if in fact we are witnessing a true and simple correction and not a pivot from bullish to bearish. I can't make either statement with confidence because there's just not enough data. I can say with confidence that after hitting 4,400, an all-time record high, it made a very acceptable correction just below the 61.8. In other words, went to 39, excuse me, and then popped back up. The fact that it made a lower high is challenging to make the assumption we are still in a fully bear market. What would make it a bear market? You've got an all-time record high. You come down, you form a base at 39, you make a lower high. If we make a lower low, that puts a lot of ammunition into those that say, well, we've pivoted from bull to bear. Until that happens, we can't make either of those statements, I'm sorry to say. And I'm basing this simply on the chart. Of course, it's going to depend on the fundamentals at play. And that I wouldn't even venture to guess what that could be. We don't have crystal balls, and when we do, they usually are just real cloudy. What we can say is that gold needs to hold above 39.30, 39.40 to 50 on a technical basis. If it does, we're still fully bearish. I would, in a best case scenario, look for gold if it continues to go lower to find support at around 3,900. And then I would look to see if it can make a higher high than this high here at 4,200. If it can make a higher high than that, even if it's only to 43, it doesn't have to beat the all-time record high. That means that there's a really decent probability that the bull market is still in play. A move below 3,900 and continued downside would put less evidence to that fact. And obviously a break below, call it 37, 36.80 would tell us we probably witnessed the best that we're going to see for a while. Doesn't mean it won't go back there in 6 months, but we probably won't see it through the end of the year or Q1.
All right. Appreciate it as always, Gary. Precise. Thank you for this. Of course, you've been credit where credit's due. I mean, you've been incredibly accurate this year, so we thank you from the viewers as well. Of course, it does get busy here with bookings over at Kitco News. Sometimes we don't have you on as much, but we want to make sure that our audience can make sure that they can go over to thegoldforecast.com to check out your analysis in the times that you're not here on the show, my friend.
Well, thank you very much. They can always at goldforecast.com. And those that want my daily commentary can sign up to become premium members. But I'm going to be here on a regular basis. I'm going to continue to publish stuff on our YouTube channel. Whether they're paid subscribers or not, I want all the people that are interested in gold and silver to get the best information I can offer, whether or not they're able to sign up for the premium membership or finances or their trading or their involvement in the precious metals doesn't necessitate that. I still want them to have solid information, hopefully actionable information, and continue to do that as I have for years.
All right. You keep us, well, you do help us keep the volatility in perspective when looking at the bigger trends here. So we'll keep watching 3,900, that level closely. Thanks for joining us, Gary, as always.
Thank you.
Thanks, Gary. Now, the takeaway is clear gold has had a historic run, and this consolidation is part of the larger story. Now, the fundamentals remain, and the technicals may be resetting. Of course, we're going to keep an eye on what these levels look like. And you heard Gary there talk about the economic data we're going to be coming from the Fed. I mean, the government shutdown. It's a busy week here at Kitco News, so be sure to subscribe. Stay tuned. I'm Jeremy Saffron. We'll see you next time.